Hello, everyone. My guest today is Randy Frisch. He's the president and CMO and co-founder of UberFlip, a content experience platform that empowers marketers to create content experiences at every stage of the buyer's journey. He's defined and led this movement, prompting marketers to think beyond content creation and truly put their customers first by focusing on the experience. All right, Randy, ready to take us to the top?
Let's do it.
All right. So this has had you've had a lot of success doing this. It's now a big conference, I think called, you pronounce it Connex, 750 plus marketers. That's annual.
Yeah. We do that in the summer. It's actually just about a month away, depending on when this airs.
That's very good. So walk me through the company today. What's the company do and what's your revenue model? I guess pure play SaaS?
Yeah, so we're a SaaS platform. Interesting history, but I won't take you through it all. Early days online sales. Learned that we built something that was built for a more sophisticated marketer and kind of moved up to mid-market enterprise type of sales. So you can imagine that there's a range in ACV there, that gets into six-figure deals.
What's your sweet spot today, though, would you say?
I would say, I'll have to be careful with this because someone will, take advantage of me. But probably
they already are taking advantage of you, by the way.
They always are. I mean, hopefully they're taking advantage of the solution. Right?
There you go.
But I would say north of 70 is very typical these days. Yep. We're selling to big organizations, but the exciting thing, obviously, and I'm sure a lot of your guests talk about this, is when we expand in those big organizations. And part of that is tied to the conference is how do you bring people together so that they can learn about the fact that what we've built is not for content marketers. It gets confused because we say content and everyone in organizations listening to this instantly thinks, oh, well, that's the content marketer. Well, the content marketer, their job is to create content. The challenge that we try and push companies on is how do you leverage all that content? How do you think about your demand gen strategy and how that would be more accelerated with content? Or how do you enable sales better with content? So when we start to think of content in the mix, then a company grows versus we all hope that leads will rein in from an inbound strategy.
So what are you upselling against? Is it feature-based upselling across your product suite, seat-based, or some utility-based upsell, a value metric?
Yeah, I won't get into like the actual details because it's boring. But the simple way to think about it is the more you want to personalize to your audience, the more you're going to pay. And it works well in terms of how we sell to different size orgs. When you think of larger organizations, companies like an AWS who'd be a customer of ours, they've got so many different verticals they sell to, accounts that they sell to, et cetera. When you think of a smaller, high growth company, a lot of them that probably come on this podcast, those ones, they're still very focused in their go-to-market. So they have less personas or less target accounts because they're trying to get off the ground. So you're naturally going to personalize less. So think of it that way. The more you want to personalize, we naturally scale. So it's a nice business model, which
how do you quantify that? The reason I'm pushing here on this is so I've probably interviewed about 60 CEOs with between 50 and 180 million in ARR, right? And all of them have a very clear axis on all three of those things. There's a feature-based upsell, there's a pricing, a utility-based upsell, like for example, Twilio's number of API calls, and there's a seat-based upsell as well. Have you gotten hyper-specific and focused on what the value metric is, the utility metric is inside of UberFlip?
Yeah. So if you're asking what is what is our equivalent of Twilio's API
That's what
call,
I'm asking, yeah.
It would be what we call streams and hubs.
Okay.
That's getting into the weeds, but think about it this way. A lot of us, let's say someone was doing a retargeted ad, right?
Yep.
Which is not what UberFlip does, but they use a solution to send out a retargeted ad, a Terminus or Rollworks, one of those types of companies, and they direct you to a piece of content. Many of us just high five each other and we're like, nice, they clicked on the ad, they engaged in the content. To me, success is where do they go from there? How do we accelerate that buyer journey so that we don't have to get them again on another channel? So how do I get them to 6 other pieces of content in that one visit? That would be how do I take 7 pieces of content altogether in theory there and create a stream? That's one of our variables.
Okay.
So the more streams that you have, I'll give you an example. A company called Snowflake uses us. They're awesome company that's grown like unicorns, and they actually have built targeted streams down to the account level. So if they're selling to a specific account, say it's Pepsi versus John Deere, they may have different content based on the industry they're selling into, the account, different factors. And they've built, last I spoke with their customer there, about 1,500 of these streams.
Got it.
So
okay. So you're selling against streams and hubs. Yeah, streams and hubs.
Exactly.
That's great.
Yep.
Give me now that we kind of get the context of the company, right? Give me your backstory here. When did you guys write the first line of code?
So interesting background. For UberFlip, it would have been in 2011, but UberFlip was more than a pivot. It was a relaunch of a company that was called Magazines that my co-founder of UberFlip started back in like pre-2010, like back in 2007. And it was a PDF solution, right? That became our MVP for UberFlip because marketers had PDFs. And fast forward, we realized that PDF was just one form of content that they were trying to manage. So the idea was, how do we bring all those various forms of content, blog posts, ebooks, videos, any form of content that comes in the future together so that we can put the right mix of content rather than let me show you all my ebooks, right?
Yeah.
Like I always kid with people, I don't go to someone's website and say, "Oh, I'm going to learn what these guys do by reading ebooks."
So Randy, if you quantify all this, right? So one of the things I always like to ask is how creative founders were early on. So do you remember how much you and your co-founder spent on your MVP before the first dollar of revenue?
For Yoav, my co-founder, it would be a way more time than me because he had tons of crazy. Can I swear on here?
Yeah. But what do you think the total amount is into the company before your first dollar of revenue, as the product is today, not the PDF solution back then, but as it is today?
Oh, money in. There was zero external capital in. To that point, we didn't take any capital until just last year.
How much total have you raised to date?
So we did a 32 million round in 2018. Actually, I should say we did a safe about a year or two earlier that was just under $1 million that rolled in with that.
So we'll come back to that in a second. But again, back to those early days. So no money in. But I mean, did you guys put in money yourselves? Was it just your sweat equity? You guys are both developers. You coded it yourself?
Yeah, we put in some of our own money. Few $100,000 each, a lot of sweat equity, taking puny salaries, all the good stories that you hear from a lot of.
So when did you get your first dollar of revenue? Again, on the current product as it is today, the current vision.
On the current product, right out of the gate, because when we
2011, just to be clear.
2012 is UberFlip, but we had transfer over revenue from the old product because we had a mix of our current customers that are marketers, and I got to do this lights thing. Otherwise, we're going to be in the dark here.
This is way more fun.
It's hilarious.
That will be the thumbnail for the video. It will be you.
People are going to be like, "What was he doing?" But we had not all our target segment. I would say on day one of revenue, that was only a small amount.
Who were you targeting?
More to media. Sorry.
Who were you targeting those early days? Like, what's the title of the person you were selling to, and what kind of organizations?
Yeah, it's an interesting shift that we had to make over the years. We were selling into the content marketer, right?
So what was that title? Like head of content marketing?
It's usually a content marketing manager. In those days, there wasn't a lot of director level, VP level. That shifted a bit.
Okay.
But even today, we got caught up thinking that was our buyer for too long. Eventually realizing that, and I mean no offense to content marketers, but their skill quite often is creation, right? They're great storytellers, writers. A lot of them were journalists or editors in their past career. And then in marketing orgs, we expect them to figure out how to do distribution, determine demand spend, and determine ROI. And they should understand that at a high level, don't get me wrong. But the majority of people who actually figure out how we go to market in our marketing teams are demand generation marketers, digital marketing kind of gets thrown in there, up to the VP, et cetera. So we had to eventually realize that trying to build a business around content marketing was actually dangerous for us. And we distanced ourselves from that term, which took us to the idea of content experience as a term that we coined and have built an industry around, gotten a lot of coverage, thrown the event that we talked about at the
Randy,
beginning.
Is it fair to say your first, call it 10 customers though, were content marketing managers?
I would say yes.
And how did you, just because I want to get a bunch more in, so quickly here if you can, how did you actually find them? How did you target them? Was it a LinkedIn search, a Facebook ad, something else?
In many cases, it was content driven, right? Because for us, content marketers, the irony was we were a solution for content marketers and we were using content marketing to educate content marketers.
So what was the blog post that worked really well for you in the early days to bring in those new content marketers?
There's one that I wrote in the early days called, I may get the heading wrong, but something along the lines of why do we send our inbound leads outbound? Right. So I kind of, talked about, I called it the social bar of death, the Twitter logo, the Facebook logo that we all put on our homepages. And my point was we spend so much money to get someone to our page only to send them to mediums that we don't control. I'm not against Twitter or YouTube. I just don't think we should send people there to consume our content. We should own their journey once we have their attention so that we can track them and learn.
So what search terms did this rank really well for that brought in a lot of new inbound for you? Do you remember?
Yeah, well, early days we were very ebook focused, so it would definitely be terms around ebooks and better understanding of marketing analytics because we were tracking the background of that. Sometimes I would also bring the wrong person, so it's a tricky thing. We didn't want the marketing operations manager at that point, which is very much what you get with marketing analytics.
So those were the first 10 folks. Obviously, you pivoted your focus over the past 5-6 years. How many customers are you now serving today?
So numbers inflated. We focus on, call it roughly 500 that are more in that actual IEP, ideal account profile, match a lot of the ideal customer profile demographics, details, size of organization, but the actual number is just over 1,000 if you include some of our earlier day, online signups.
Like long tail folks, paying cheaper grandfathered prices.
Exactly.
Yeah. So can I take that 500 times the ACV you gave me earlier, 70 grand? I mean, that puts you at about 2.9 million a month right now in revenue.
No, that number would be off. We don't share those numbers exactly publicly, but I'll tell you, we were over 10 million in revenue when we did our financing. So
that was, which is kind of, I mean, so is it is it a stretch goal for you to say that you guys can hit 20 million by the end of this year in terms of run rate, or does that gonna have to wait till 2020?
Fiscal is doable.
What's your fiscal end?
Our calendar is fiscal. Calendar is doable. Fiscal would be tricky. It's year end anyway soon for everyone in one world, so we all get confused by these terms. But yeah, I would say that calendar is doable. We're in one of those industries where, we don't pretend to have 100% year over year growth. We never did. That's probably why we didn't raise capital early days. We didn't have that, we're a rocket ship growth story going on. We had more of the sustainable growth rate, right? How do we grow year over year at a sustainable amount? And that growth rate for us was always somewhere between
wave your arms again, do the dance.
There we go. Between 30 and 50% year over year for us is kind of been our range. And, to be honest, we get depressed when it's in the 30s, and then, people around us remind us that those are our bad years.
Yeah, that's not bad. I mean, right. So, and you said that was September last year you did the raise?
No, it would have been April of last year.
Okay, April. So if we we're now getting to August of this year. So if we go back exactly 1 year, you were basically doing something like 11 or 12 in terms of run rate back then.
Yeah, in those ranges.
Yeah. So why raise the capital? I mean, it sounds like you guys knew how to do this without capital. Now you just took I don't know how big it was, but you took dilution. You're going to have to drive burn now.
Yeah. No, it was a great question. I'd say in a nutshell, we did, me and my co-founder, Yov, we did a lot of soul searching at that point. We didn't have any firm exit opportunities at that point, but we definitely wanted to take some chips off the table. So there was a secondary component to what we explored and were able to do. We had actually a couple of nibbles.
Wait, hold on. Explain that. Randy, just sorry. I appreciate founders that understand how to create liquidity, not only for yourself, but for early employees that took the risk with you. And I think a lot of people don't actually understand how that works. So just explain quickly, you raised 30 million. What % of that went towards secondary versus operations? And then explain how it works.
So I don't share that. We don't share those numbers publicly.
Okay, well, explain how it works.
But I'll explain how it works. So the idea there was, and it's interesting. Before I explain that, I'll set some context for everyone listening. We went through this education ourselves in the process that you've kind of got, the traditional VC who wants their 10x return and wants to put in a ton of money, wants you to spend that money very quickly. And if worst case you need more, they'll fund you as long as they see that growth. On the other side, you've got PE firms who very numbers based, many of them have theses where they, you run their game plan, they bring in been there, done that execs. And we felt like neither of those appealed to us. We weren't ready to give over the keys. And on the other side, we didn't want to become the company that was going to burn a crap load of money to try and get to 100% year over year growth. Like that wasn't our mindset. Then we discovered these growth equity firms. That was the term that was being thrown around with us. And we honestly never knew they existed. I think that's because a lot of them are more interested when you get to that 10 million recurring revenue number and up, because they're looking for a lot of the ingredients similar to the PE firm, but they're looking to kind of like a 3 to 5x return over that many years. And that exit could be to a strategic, it could be to a PE down the road. And I think that's what appealed to us, is we felt like, to try and sell the company, not that a buyer existed, we'd be selling ourselves short of the potential that we had. But this would give us that runway. Now, most of these growth equity firms we found were very open to the idea of a secondary, meaning that that we could sell, simply we could sell some of our equity as part of the deal. So the other nice thing that does is, we talk about $32 million, and yes, I don't share the split, but to understand it's not that the $32 million inflated us to a valuation where you would figure out what that value would be, whether it's anywhere from 5 to 10x as people would do when they're raising around. We didn't necessarily have to do that on the 30 coming in. We did that on the amount of money coming in, and the rest of it, yes, does cause further dilution to the rest of our shares because we're selling those shares, but not in the same way.
Yeah, guys. So I'm going to try and say that in a sentence. You correct me if I'm wrong, guys. So what happened here is, right, they raised $32 million, right, with UpData, right, which is known for this kind of deal. Of that 30, now this I'm speculating. Now this is not from his mouth. I'm speculating, but let's say that 10 million of that went towards helping early founders and employees basically get liquidity. What that means is if you guys owned as founders 80% of the company, maybe you sell 5 or 10% of your equity, right, for that 10 million. You guys take cash off the table. That 10% of your own equity that you sell does not dilute the rest of the cap table. What does dilute the rest of the cap table is the other 22 million that came on and stayed in the company on the company balance sheet for operations of the secondary. Is that accurate?
Absolutely.
Now, question for you. You used SaaS Capital, 3 million 2016. Was that effective for you in terms of, whatever you did keep on operations a year and a half later, having it be less dilutive? In other words, were you able to turn that 3 million, relative to your CAC and payback and actually drove ARR booking growth?
Yeah. So first I'll say I really love the guys at SaaS Capital. Great partners. Todd is fantastic there. UpData, we've been really lucky to have as a partner too. In retrospect, like looking back, it's always easier to say I never needed that money from SaaS Capital. We never actually leveraged it, but it gave us the comfort to go out of our comfort zone, right?
Which meant what though specifically? Driving up your payback periods to 18 months to be more aggressive with customer acquisition, or what?
Yeah, it was a combination of being more aggressive with customer acquisition, more hiring that we wouldn't have been comfortable to do, even hiring some more senior folk where we would always, we're very fortunate. We found some awesome people who are up and comers and they've kicked ass for us over the years.
What's your team size today? How many people?
We're just under 140.
Got it. And then quantify that CAC risk here for a second. So to get a new $70,000 ACV account, are you comfortable sending the full 70 grand, so 12-month payback to get the customer, or are you longer or shorter?
Sorry, lights are going. Let's
no
save
worries.
it this time. We were able to manage that in a couple of ways. So short answer to answer you is yes, we're willing to spend, even back then we were willing to spend more upfront to get that customer. But there's certain things that we learned along the way. And I'm not saying we knew this on day one. Yov and I were both tech rookies going into this. In cash flow as an example, just moving to upfront payments from monthly recurring credit card transactions was such a big change for us. I mean, it makes perfect sense, but you don't realize the impact it can have to cash flow. So those were some of the things that, when we took the SaaS Capital money, we knew we were going to shift there. We just, you don't know if you're going to be successful.
Yeah, you don't know how many people you'll convert. Yeah,
exactly.
To annual upfront.
So we ended up converting more than we would have hoped to upfront, which reduced the need to kind of take some of that money from SaaS Capital. We did dip into that facility, but it was more, I can't remember what our equation was, but we always wanted to have like X times payroll in the bank account ready to pull on. But SaaS Capital was great. I mean, my only regrets, and this isn't SaaS Capital, this is our own negotiation. I wish we didn't do warrants tied to it. We did it so that we keep the interest rate down a little bit more. They're flexible on whether warrants are in or not. They just need a higher interest rate. So
it's not the thing is like, it's not like, I don't know how sophisticated you guys were in your modeling, but whether it's, and this isn't a hit on SaaS Capital, but you look at Lighter Capital, SVB, any of these revenue-based financing companies, but was yours revenue-based or was it a term loan, a fixed interest rate?
It was revenue. It was a multiple of ARR.
Yes, but you paid back on a % monthly of gross receipts, correct?
Some of this language I'm going to forget / gets blurred in my mind, to be completely honest with you and your listeners. So I don't want to misspeak, but basically they were term loans, but we could take in tranches, and there were minimum amounts and a payback and an early payback penalty and things like that. So we, that facility eventually grew, but when we actually took the money from Updata, we paid off the SaaS Capital.
So no debt sitting on the books.
At that time, no. We've since got a.
Today, okay.
Well, we're not tapped into it, but we ended up working with SVB. Well, I've always liked. I love SaaS Capital. I've always liked the team at SVB. I think they're good people.
But you just said you don't like warrants on the SaaS stock deal, and SVB usually attaches warrants to their lines as well.
We don't have warrants.
Okay, so there are no warrants on your SVB. You're sure about that?
Yeah, that was important. It's funny
it's
because
not snuck in on page 35 and paragraph 3.
If it is, no one's going to, someone, if there is, we'll have a difficult conversation with someone here. But it's funny because I look back on those warrants with SaaS Capital, and it's so easy to look back. It's like, oh, why did I have to give that? We gave it at a choice, but I ultimately wish that we didn't, because, and this is not a knock on SaaS Capital again, but they were there for money. They didn't help us grow the business in any strategic way. That's, and they don't lie about that. That's their purpose. And
you're paying them back a penalty. Like they usually take a 1.3 to 1.4x repayment cap. So you're paying back like 3.5 million. And I mean, the cost of capital is like 500, 600 grand.
So when I'm dealing with a bank or I'm taking money in that way, I want there to be a very prescribed rate where I understand going in and I understand at the end, this is my guaranteed payback to them. So I justify the risk that I'm taking on and, the cost of that risk, that I'm able to take because of them. I don't like to give them more upside. And that's just me. I mean, I know different entrepreneurs will think about that differently, but that's just how I think about it.
Yeah, I just realized we're way over time here. So some quick rapid fire stuff for you. What's the breakdown of the 140 team members between engineers and quota carrying folks?
So engineering's close to 40, sales is just over 30, CS is about 30.
So 60 kind of CS and sales, but 30 are quota carrying.
Yeah, we've got a large marketing team, something I'm always criticized for, but
no, nothing wrong with that.
I have lots of ways to defend it, even though I'm often.
Well, are people sticking? So when you look at your, CS, if you have a big CS team, I'm hoping your net revenue retention is well north of 120, 130%. So, I mean, when you look at your churn plus your expansion, are you in that range?
Yeah, we're in good shape there. I mean, we can always be better. Historically, from a revenue churn perspective, monthly, we were around 1.5%.
Okay, so call like 17, 18% annually.
Our goal is to get that closer to 1, right? That's ultimately the goal.
Randy, sorry, I don't mean to keep cutting you off, but I want to make sure the audience gets takeaways here. So right now, you're at about 18% revenue churn annually on a gross basis, 1.5 per month.
Correct.
And does expansion more than make up the 18% churn?
I think we have more work to do there.
Okay.
It is in some quarters and then not in others. And I think that's, we're trying to do a lot now to become more proactive on expansion. I think we see a lot of great expansion with the business unit that buys from us, but really that's not expansion, right? That's upsell. The way I look at it.
I think it's the same thing. There's just different ways to drive upsell. You sell deeper in the same department, but then you also want to get cross sell to other departments and other teams and things like that.
Internally, we define the cross sell as expansion, and we define the internal department or the specific department that we've sold into as upsell.
Yep,
right?
Fair
because
enough.
They're increasing their use of the platform, like we talked about at the beginning. More personalization. We need to do more. We want to do more. Great, but if we can actually get into like AWS is a great example, right? Because they have so many different business groups and so many different initiatives. If we can get into some of those other regions, there's a great opportunity there, and we have a great partnership with them in general. So it's lot of hope there.
And Randy, how aggressive are you guys being, right, with your current capital structure with burn? I mean, are you comfortable burning like $100,000 a month, or does that keep you up at night? Are you actually cash flow positive? Where do you kind of put that stake?
It's a funny question because we had some help when we did the financing about a year ago, and the Updata guys, I'd say they're very disciplined in their approach. I mean, it's in their name, Updata. They're all data focused and numbers focused. But one of the advices by the, I guess you'd call them investment banker / advisor that we used in the process was like to them was, you're gonna have to get Randy and Yoav comfortable burning money, right? Because we had essentially bootstrapped to that point, other than that $1 million save to get over 10 million recurring. So it was we've had to adjust, and I've also had to let go of the reins. I think part of that early days of the business, I was a COO in addition to president, but now I'm more CMO and more out there advocating for the company. A big part for me was finding someone to take over those COO reins.
Randy, hold on, sorry, before we get off on a tangent. So today, How much are you burning? Are we talking like $1 million a month, $100,000 a month? Generally, where are you?
I apologize. Those are numbers I just don't share, but it's very.
You are burning though. You're not cash flow positive.
We are burning, but we have our mindset with the capital that we took is it gets us to our next exit. Right. I always say next exit, not a final exit.
So were you raising for like 18 months of burn? Then that's usually what people would do.
No, we raised from the mindset of 3 years minimum.
Okay, got it. So you raised for essentially 36 months of burn.
Minimum, yeah. But really 5, like I said, the mindset of Updata is 3 to 5x return in that many years. And that's our goals. We want to get to that next exit. Needs to be for us a minimum of 3 to 5x what that valuation is when we took money. And the money that we took is designed to get us to that point.
Yeah, very good. Let's wrap up here with the famous 5. 1-word answers if you can. Number 1, favorite business book?
I love Start With Why.
Number 2, is there a CEO you're following or studying?
I'm always just intrigued by Musk.
Yep. Number 3, what's your favorite online tool for building your company?
Ooh, shit. I'm gonna go with. Other than UberFlip, I'd probably say that it's marketing automation platforms.
Which one?
I love them all. They're all
Pick
my
one.
I will give some love to the one I use right now, which is Marketo.
Number 4, how many hours of sleep do you get every night?
I would say that I get at least 6.
And what's your situation? Married, single, kids?
I am a very luckily married man. I've got 3 amazing kids who are 12, 10, and 8.
And how old are you?
I just turned 40 this past year.
Very good. And last question, what do you wish your 20-year-old self knew?
Just to be confident in a room. I think I was 22 when I realized that. So going into a room, being confident there, it means you gotta know what you're going to talk about in that room. And as long as you do, people are willing to listen as long as you got good value to add.
Guys, UberFlip, again, founded back in 2011. Today, 500 customers, doing call it 14, 15 million-ish in ARR, hoping to break 20 million in ARR next year. They were doing about 10 million in ARR back in April last year when they raised an additional round of funding. Total in the company to date, about 32 million bucks. Part of that last round, though, was a secondary offer, meaning some early folks got some liquidity, which is always nice. 140 folks on the team as they look to scale. Churn annually on a gross revenue basis is about 18%. They're working on driving better expansion revenue to drive up their net revenue retention. Randy, thank you for taking us to the top.
Absolutely, Nathan. Take care.